Good morning and good afternoon to everyone who's on the line. This is the start of the OPEXEngine monthly SaaS benchmarking community webinar. Today we're going to be talking about calculating COGS and CAC, and we have two special guest speakers. But before we get started, I'm going to talk a little bit about housekeeping. Everyone on the line should have their phones on mute. If you're hearing an echo or having any trouble hearing me or the speakers, try dialing in on a landline, but also make sure that the sound on your computer is turned off or it'll cause an echo. You're welcome to send questions into chat to the moderator. That's me. We'll have a Q&A at the end unless we see some questions that fit the discussion as we go through. And then if you're interested in continuing the discussion, feel free to go to the SaaS Q&A on our website or to shoot us any questions or comments, and we'll be happy to take a look at that. Well, today I am very pleased to have with us two members of the SaaS benchmarking community that OPEXEngine runs. We have Patrick Brickley, VP of Finance at Everbridge, which IPO'd, was it last August, Patrick? You there, Patrick? Can you hear me, Patrick?
Can you hear me now, Lauren?
Yeah.
Oh, great. Sorry about that. Yes, we IPO'd in September.
In September, that's right. And previously, Patrick was in finance at Google after coming through the acquisition of ITA Software, where he was a business partner and finance lead to senior business leaders and across functions. And we also have with us today Kerman, VP of Finance at Adaptive Insights. He's also a member of the benchmarking community. Kerman has terrific experience implementing planning and reporting systems in large and small organizations and working across business departments and working with business leaders to help improve operations and growth. So with that, I'd like to kick off our conversation, first talking a little bit. I'll do an introduction about OPEXEngine, and then we'll jump into the meat of calculating COGS and CAC. OPEXEngine runs the SaaS benchmarking community and provides access to all its members to the proprietary benchmark engine where software and SaaS companies, primarily SaaS companies, can compare their detailed financial and operating metrics to over 60 software and SaaS specific peer groups. You can also compare yourself against peer groups by size of revenues, by average contract values, by investment levels, and compare not just financial KPIs, but also specific operating areas like sales, marketing, R&D, G&A, professional services, customer support, and then all the key SaaS metrics. In addition to the data platform, we also provide members a forum to meet peers on the East and West Coast, which is open only to finance executives to discuss in a peer community topics like what we're discussing today, but doing it face-to-face, as well as each quarter we do deep dive research into areas like SaaS sales structures and metrics, which we're doing currently in Q1, a searchable knowledge base, which we offer to our users, online SaaS Q&A, and more. So if you're interested and you're not a member of the SaaS benchmarking community, please contact me or go to our website to find out more. So with that, I want to set the stage at the top of the hour in terms of this topic and the importance of the topic. I think the importance of unit economics and the associated metrics like CAC, long-term value of customers or lifetime value of customers, and the LTV CAC ratio is pretty well established in the SaaS world. But going from the 50,000-foot analysis that you read about on the web to the ground level is what many of OPEXEngine's customers grapple with every day. So how you calculate your operating numbers has a real impact on your decision making and how you build the value in your company. SaaS companies are totally focused on gross margins, which is driven by your COGS number. And at the same time, the unit economics of your customer profitability is one of the key operational analyses that investors look at when valuing a company. But it's also important for internal use as well. For example, if you think your CAC is too high, then your executives are probably going to be quite conservative about investing new money into new lead generation programs or expanding your sales and marketing, and especially if you're not quite sure of the outcomes. Whereas in actuality, if your CAC was lower than you thought, you could afford to spend more, try out new markets, test new sales and marketing activities, and that may be necessary in order to generate greater growth. So getting these numbers right is critical for everyone in senior management. And most of the people online now and most of the people, all the people in our benchmarking community are actively responsible and working on figuring out these numbers. So with that, I'm going to turn this over. Sorry, I'm skipping ahead here on the slides. Let me move that back. Sorry about that. Let's focus on the first topic. Let's start with CAC. So, Kerman, at Adaptive, what do you put in your CAC calculation, and what do you take out?
Yeah, so here at Adaptive, we break up our CAC into two measures, actually. We have a new CAC, so for new business, and then we have a renewal CAC. And so essentially in the new one, we include all of our sales and marketing costs, and we exclude any costs associated with going to get the renewal. In our case, that's the customer success group that we kind of point toward the renewal. So effectively, we put everything else in the new CAC, including sales management, sales operations. We actually have a small scoping team that's in there. We've always kind of debated about whether or not that belonged there or in services, but for now it's sitting in our CAC. So yeah, those are the kind of things that we bucket into our cost when we calculate CAC.
And before I ask Patrick, I just wanted to ask, have you seen, as the company has grown and, presumably early on you put everything just that was in the line item for sales and marketing into CAC, is that how you started out? I guess I should go back to that. And I guess what kind of things have you seen change over time, and whether at Adaptive or at some of your previous companies?
Yeah, so we tried to, I think earlier on, when the renewal base isn't as large and the company isn't as, you just don't have a large renewal base, to simplify things, you just include everything kind of within sales and marketing. But as the company matures and grows, and as your renewal base gets larger, you do need to go ahead and separate those costs. When I was at Veritas, we did the same thing. We took great care and kind of putting all the costs related to a renewal into a bucket so that it wouldn't, in most cases, it artificially lowers your new customer acquisition cost, because your CAC on the renewal business is pretty small, and that's kind of how the model works anyways. So here at Adaptive, what we're doing is we're refining how we bucket the cost, and so anything that's really renewals related, we put into its own bucket, and then as we look at the new CAC, we're saying, okay, this is the total bucket, but then there's always discussions around, well, can we even split that up a little bit more whether it be by segment. So our sales force, our go-to-market strategy is we have verticals around software and around not-for-profit, and then we also have segments like SMB, mid-market, small enterprise, and there's always interest around, well, can you break up your new CAC into a little more detail so that we can get a sense for what the costs associated with, for example, the not-for-profit vertical. Yeah, so as we mature, there's always these discussions around, hey, as our go-to-market strategy changes, can we measure how effective and efficient that particular go-to-market stream is?
Yeah, it's a great point because I've seen some really great theoretical presentations about how important it is to analyze your CAC and your CAC ratio for each segment of customers, but it's one thing to divide up figure out what denominator belongs to each segment, but it's pretty hard to figure out what expenses belong to that segment versus another segment.
Absolutely, and one of the challenges is that when we have a meeting about it, is I tell the execs, like, look, this is more informative now. It's not, I would be hard pressed to say let's make hard decisions around it, because in a lot of cases, like you mentioned, on the expense side, you have to do a fair amount of allocations to bucket it, because we're not capturing costs that way, and to do so there would be a lot of effort involved around creating just cost centers and then being able to book everything appropriately and tag all the heads and everything. So yeah, you bring up a very good point. It's kind of informative, and whether or not it's useful for decision making at this point, it's probably not for us. But I can see as we're maturing that there's some demand for that, and so we kind of have to make sure that we're considering that as we break out our measurements and look at new CAC and then try to explain why is it going down as fast as we want, or is there a question like how effective is our SMB sales segment?
Mm-hmm. Yeah. No, it's interesting. And Patrick, do you have, starting with the first question, at Everbridge, what do you put into CAC and what do you take out?
Yeah, so similar to Kerman at Adaptive, we include, so first we do distinguish between cost to acquire a new customer versus cost to renew or upsell. And then in the cost to acquire new, we include obviously the cost of the sales team, we include BDRs, we include a portion of marketing. We try to do this by vertical, but we, as Kerman was just describing the challenges at Adaptive, we don't, at Everbridge, we haven't set up our cost center structure to really codify how we bucket the expenses. Instead, we found that we're able to do a good enough job at measuring CAC by vertical by just being in really tight sync with our marketing leadership to understand where they are putting their marketing dollars, and then from a Salesforce team, they pretty much run by vertical, so we have a pretty good line of sight there. So we're able to still do CAC by vertical without doing a whole bunch of systems work. And we do find in our business that CAC by vertical is very informative, also CAC by region. And one thing though that's come up in recent conversations that we haven't been including in CAC, but I'm thinking about doing this going forward, is costs related to our freemium model. Right now we have some operations costs related to customers who use some of our services for free, and ideally those customers are using our services for free because we want to have a clear path to getting them to becoming paying customers. And so in the meantime, it's probably pretty reasonable to think of that cost as a marketing cost. And then that begs the question of, do we include it in CAC or not? So that's, obviously these, as businesses evolve, we have to kind of rethink how we define these metrics, and there's an example of how, as Everbridge evolves, we need to think about redefining that. I could imagine that including some of our freemium costs in CAC, one way or another, would catalyze a whole set of interesting and useful conversations with senior leadership.
Yeah, no, I can imagine. We had a pretty hot discussion about that at one of the last set of SaaS finance meetups, the in-person, member meetings that we have, where that exact topic came up about freemium models. And I can't remember if it was in New York or in Denver, but there were a lot more companies with that model, and most companies had not been thinking about, you have two sides to it, because the cost to run the freemium, hosted, and a lot of the extra burden that it puts on the systems to run the freemium model, it really is a question of whether that cost should go into COGS, because, as you say, the whole freemium model in general is really a lead generation program, and it's not paid. And you have, do you have people who support it? Do you not? Is it all self-service? But is that all sales and marketing expense, which would impact both gross margin, maybe improve gross margin because you're taking it out of COGS, but then worsen your sales and marketing expense. So,
yeah, at 50,000 feet, I guess the point of looking at CAC and lifetime value is to understand whether you have a sustainable growth model. And so that, in that light, it does make me really think hard about our cost of a freemium service. If, to the extent that that's part of our growth strategy, then we probably need to be including it in ours. Obviously, it would vary by business, but it is a part of our growth strategy. It should probably be part of our CAC.
Yeah. Well, and it's, it brings up the other question of how do you work with your executives, as the analytical head from the finance organization, at times when a new way of accounting for something can change significantly key metrics that they're basing their business decisions on. I'm just thinking, I've had several companies that were anywhere from 30 to 50 million that we started working with, where they were putting all of their sales and marketing into CAC, and clearly some portion of their sales and marketing was being spent on programs, both sales and marketing programs for their existing customers. So they'd been operating under the assumption that their CAC was quite high, and with the change of accounting, you could reduce your CAC quite dramatically in this case, but they haven't really changed any of their expenses or spending or investments or acquisition of new customers. So do either of you have any good examples of how you helped explain that to your stakeholders, whether internal or external, with an accounting change like that has a direct effect on the business metrics of the company?
Well, this is Kerman, and we haven't. So I think that one of the biggest ones, and we haven't actually done this yet because we're doing a 606, the new revenue standard conversion, and the controller and I have had discussions around the methodology about deferring commission expense, and that's going to have a significant impact for us on our new CAC. Because our commission, our period expenses will come down from a sales and marketing perspective because we're going to defer these commission costs. And then the question that I have is we have an internal target we have an internal CAC target that we want to reach over an 18-month period, and so we've been discussing, well, does that target come down? Should we reverse the effects of the deferral and just show it up all as period costs again in our CAC calculation, how to do comparability against historical results around CAC, and then the methodology by which we agree to do the deferral over what period of time, since our average contract length is more than 1 year. So those are things that we're discussing. We haven't had the discussion at the executive level in terms of comparability and how we want to look at it. We're more discussing it internally within the controller and myself on what's the methodology, and then with my team, what's the targeting around it as we talk with sales ops. What's the targeting around CAC and where should we be headed. And then we do use a fair amount of benchmarks actually that we get, not only from OPEXEngine but also from other sources. And it'll be interesting to see how those benchmarks are impacted by the timing of when companies decide to move on to 606, because there is a window, and how that affects benchmarking and where do we see from our peers around their CAC ratios.
Mm-hmm. We've got a number of questions here in the chat. One of the questions that comes up frequently is the time lag between sales and marketing expense to acquire new customers and when you tie that to the customers. We usually advise companies that it depends on your sales cycle. If you have a very short sales cycle, you might do it 1 quarter lag. If you have quite a long sales cycle, you could do it 2 quarters, or some companies even do it a year, last year's sales and marketing expense against this year's new customers. Do you have any thoughts from either of your perspectives on the lag that makes the most sense to you?
This is Patrick. We do try to, since we look at CAC by vertical, we do try to take into account the degree to which the sales cycle will differ between verticals. That could also be the case with different products. So it's tricky. We've done a fair amount of work looking at it, taking a couple of different approaches, and I think one key thing we've taken away is there's no use necessarily in over-engineering. So whether we're taking into account the most recent quarter or 2 quarters or 3 quarters, I guess what we found is that there are, at the end of the day, we want to have the right metric to influence management, so that we're building a sustainable model. And we've tried to find the right balance between what's a measurement that we can repeat consistently, and that is very reasonable in terms of what it includes, and that includes duration, and leave it at that. We could probably always fine-tune it to be much more precise, but I don't know if the cost benefit would make sense.
Yep.
And an adapt. Yeah, here we always use current period expenses measured against, so everything is current period. We haven't really looked at our sales cycles are fairly, they're highly variable, but most of them kind of range in the 3 to 6 month range. So I could see how you could start to analyze, kind of looking back 2 quarters and then taking those costs and then using that in your CAC analysis. But currently, right now, we just use periods expenses.
Mm-hmm. I guess, correct me if I'm wrong, if you think about if you have the higher your growth rate, I guess the more it would impact your analysis of CAC based on the time lag. So let's say you were taking this year's expenses against this year's new customers. If you thought about the equation, if you took this year's expenses against next year's new customers, and assuming that you are following a pretty steady, steep growth trend, it's just that's going to make your CAC smaller because you're going to have more customers next year, and that's going to be a larger number of customers to divide into the expenses. Fun with numbers. One question I have, which I think is an interesting one, is if you have a big range in your average contract value, so you have some customers that are $10,000 customers and some that are $250,000 customers, do you have any thoughts about how to best interpret the CAC number? Because obviously you just have to apply it against an average maybe of your average contract value across the board. But do you have any thoughts on the nuances, especially around the outlying contract values? Sorry.
So here's where our segment analysis becomes fairly important, just because our SMB space, the average contract value, those are much lower than the mid-market and the small enterprise space. And so that's why we've been trying to get a sense for breaking up the CAC a little further, because you would expect that our SMB CAC would be much smaller, actually, because of the business model, because it's more insight driven, etc. And you would want that to be smaller because your the average deal size is smaller. So, but interestingly enough, we haven't found that, and that's why when you have allocations coming in, and they're somewhat arbitrary, in the sense that you're not sure that it's actually a driver of the activity, that's when it becomes challenging. And so, that's exactly why we want to move to getting a little bit more refinement on our CAC, because as you build out your kind of go-to-market model, you want to make sure that it's operating in the way that you anticipate, and you're getting the returns that you kind of plan for, or kind of how you set the model and the cost structure.
Yeah. Okay. I'm going to jump into the next one because we've got so many great questions coming up. I want to try and leave time at the end for Q&A. I just wanted to look quickly at the other side of this equation in calculating CAC, which is defining customers. And I think, and correct me if I'm wrong, at your companies, but it seems like most companies define their number of customers for the calculation of CAC by the number of customer accounts that they have in I was going to say Salesforce, but whatever their CRM system is. But it sort of begs the question that we talked about before. Do you include all those freemium subscribers? What about trial users? How do you handle, do you an upsell or expansion user, especially if you're talking about a very large enterprise, is General Electric, which has something like 10 business units that are all Fortune 500 companies, or a large number of them are each equal to a Fortune 500 company. Is that one customer? Is that 10 customers? I think what I've seen lots of companies just sort of follow whatever their sales organization's definition of a customer is, which often is driven more by the sales structures that are necessary to manage territories and account managers and all of that, not necessarily from a analytics of, from a finance perspective. But I'd love to hear how you do it, both how you define your customers and nuances that you've seen with that. So maybe Patrick could go first on that.
Sure. So we try to keep it simple. We include only paying customers, because any freemium customers come to us basically through a very, 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 very low cost acquisition model. So we don't. There isn't much CAC to think about there anyway, in order to get those freemium customers. So we focus on the paying, and we do have some nuances, such as for a large global organization, if we're sending multiple invoices to multiple different addresses throughout the world, then we might count each of those as individual customers. But I think what we try to be mindful of when we're thinking of CAC, and this goes back to, I think, also the previous question, do you include the outliers, the mega deal in your calculation of CAC? I mean, I think at a high level, we're trying to think about our unit economics and are we building a sustainable business model. So we will, if there are outliers, whether it be a large deal or maybe one customer win, but given the nuances in our customer count, they turn out to look like 10 wins because we count them 10 times. We'll try to normalize for that because if they would otherwise skew the numbers and distract management from thinking about the long-term business model.
Mm-hmm. Cool. Kerman?
Yeah, we keep customer counts pretty simple, so it is the paying customers, and we basically define it on the accounts that are coming through Salesforce. So we work closely with sales ops. So when they create a new customer or a new account in Salesforce, like we're kind of in agreement that that's a new customer that shows up. The one area where it does get a little bit challenging is for when we get into these larger enterprises, specifically like Coke or like Berkshire Hathaway or these other places that are just big conglomerates, but we might sell into divisions. We do count that as a separate customer. So, Coke bottling North America might be different than Coke Europe or something. And we do have that debate sometimes, like, isn't that just one customer? No, it's really, it's 3 separate sales efforts. When I was at Symantec and Veritas, that was always the issue. But at some point when you get over, like, when you have like hundreds of thousands of customers, it doesn't become that material. But we always debated, like, is Berkshire Hathaway one customer, or is it, is it 30 or something like that? So, but we keep it simple here. We agree with sales on what a customer is, and then on what a new customer is.
Okay. And there's a couple of questions, so I'll throw it in here because I think it fits as to, the traditional way I think of calculating CAC is expenses divided by the number of customers, but some people also do it by CAC divided by new bookings. And then there's always the question of, new bookings, do you include upsells or not? But do you have any thoughts about CAC by revenue dollar, however you define that, versus by numbers of customers?
We do both. We do it by new bookings dollars to kind of see, and the reason why, so it's basically how much are you spending to acquire $1 of new business or $1 of renewal business. We do include add-ons and upsell in our new CAC and new dollar CAC. And effectively, it gives us an easy way to figure out what the payback is. So if our CAC is like 3, we think of it like, okay, it takes us 3 years to get back that $1.
Mm-hmm.
So it's kind of a very fast way, and so we do both. And we do kind of a dollar CAC and then just a pure how we got 1,000 customers this quarter or this year. How much did it cost us to acquire each of them on average?
Yep. Okay.
We rarely do it on revenue. We stick to bookings.
Okay. Yeah, that makes sense. Patrick, do you do both as well?
Well, we focus more on the cost per customer count, but when we report, we do put it side by side to the average size of the contracts that were won, and also in that same table we look at months to payback and lifetime value. So, and then separately we'll also look at global sales and marketing costs as a percent of revenue. So we don't, I guess maybe it's another way of saying that we do both. But principally, when we do our kind of headline CAC calculation, we are just focused on customer count. And a lot of that tends to be because within each of our verticals, the deals tend to be fairly homogeneous in size. There isn't necessarily a huge mix or a mix that changes, frequently over time. So it's in an effort to keep it simple and repeatable. We found that metric has been good enough for us to be informed about the right decisions to make going forward.
Mm-hmm. Okay. Well, and one last slide in this area, one of the issues that has also come up is just sort of the mechanics of, we talked a little bit about the time frame in terms of a lag, but there's also the time frame in terms of how some companies are looking at their, looking at CAC every month. Some are looking at it on an annual basis. The problem is when you do it every month, then some months you have big expenses like a big event, or you pay your CRM license, all up front, and doing that against revenue or number of customers at a given time may not match up. Do you have any other thoughts about areas where this is a problem, just matching up and making sure that you're syncing up timeframes? I'll throw that out to you, Patrick.
Well, I mean, nothing really more than Neil mentioned before. It's tricky to try to, if the effort is to figure out are we building a long-term sustainable model, then it is important to try to match across timeframes. But we don't. We try not to over-engineer it. Our sales cycles tend to be a couple of quarters. Our contracts are never shorter than 1 year. So we'll look at CAC quarterly, but no more frequently than that. I wouldn't want to wait and only look at it, annually or even semi-annually. I think quarterly is a good cadence for our business in order to identify trends where we need to take action.
Okay.
Yeah, we look at it quarterly and then on a trailing 12-month basis. Quarterly, basically, to give us kind of a view around how. We look at it quarterly and then we compare it back to a year ago to get the seasonality and just say okay, Q3 versus Q3, and then on a trailing 12 basis just to see how we're improving toward our overall kind of targeted CAC. So we don't look at it on a monthly basis for the reasons that you mentioned. There's too much variability in kind of monthly expenses and when something might occur.
Yep, exactly. Okay. So then let's jump into COGS. There's SaaS companies typically put their hosting expense, the cost of revenue in, and maybe we should, instead of saying COGS, say cost of revenue. But there's some nuances there in terms of you may have customer support people, the headcount, and salaries and things go into COGS, but what about all the Zendesk or the customer support system that you're using? I've seen companies where that all tends to sit in G&A. Payment processing fees, especially if you're a transactional company, typically that goes into COGS, but what if sometimes what we see is that with companies that do sort of one-time big deals, sometimes the expenses around that end up in OPEX in one way or another. So just some of the nuances that you've found in managing this from a SaaS company, and particularly for you, Patrick, going from being a private company to a public company, are there, and certainly you've spent your fair share of time with auditors and various accountants, any nuances that you've seen that you thought were interesting or worth pointing out?
Yeah, you could throw bankers and analysts into that as well. And certainly, right, in SaaS, you are your gross margin, and certainly in my experience to date, first question externally is around revenue growth rate. The second one is around gross margin. So we want to strike the right balance between putting on our best face, but also running the business and building it, to be sustainable. And so we just try to keep cost of revenue as pure, if you will, as we can. So really focused on the direct cost of fulfilling our subscription services, so that it'll include hosting, it includes the people who work on the hosting and all of the expenses related to them, salaries, benefits, facilities. It'll include our messaging-related costs. It'll include depreciation and amortization of equipment or long-term software maintenance contracts that relate to that equipment. So it's, like I said, we try to keep it pretty pure. One thing that we did a couple of years ago was when we realized that within all that hosting cost, we were including the cost to acquire and host all of the machines that were used by development and QA, including whether it be test or stage environments. And so when we quantified that cost, we realized it was very material to our gross margin. So we, ever since then, we have been allocating that at the end of each quarter to the R&D section of OPEX. So that way, what remains in cost of revenue is really the cost of those machines and the people who take care of those machines that are used for production. And the cost of machines that are used for development, those end up in OPEX.
Okay. Yeah, that's a good point. Kerman, how about you? And you've had some experience with some pretty big companies with a lot of complexity and then smaller companies, so it'd be interesting to get your take on it.
Yeah, so from a cost perspective, at least, and for Adaptive, it's pretty straightforward. So since we have a services business as well, so if we look at just the subscription side of the house, it's mainly our hosted cost in there, and then as you go into services, we do put tech support or customer support in there, some education or training COGS go in there, and then we did find last year as we were going through kind of a review with the engineering teams that there was a kind of a support team sitting in R&D. They were basically doing tech support, but kind of a different level of tech support. And then we had to make an adjustment there because it really belonged in COGS as opposed to R&D expense. So no one really liked that, but that was, I guess the R&D, our chief product officer liked that because his R&D expense came down, but it did impact margins, gross margins at least. But those are the kind of discussions, especially as a company grows. You got pockets of or functions of teams that are doing various functions, and then as you grow, they kind of instead of doing 4 things, they end up doing one thing, and then that one thing happens to be kind of more customer support or tech support related, and then but they're we just never caught up to them, and so that was a change. There's always a debate around customer success, and then is there a customer care organization that's embedded in your customer success group? We found that at Symantec and Veritas, and what do we do with this customer care team that basically does, they kind of the front line, they answer the phones, they do kind of pseudo tech support, kind of front line, And we ended up with the auditors at Veritas, kind of determining that wasn't a cost of goods sold. That should stay in OPEX. But I could see, those kind of discussions again as companies grow and your functions get more defined. It's pretty important to kind of get into the COGS world. It's funny because after our pre-call with Patrick, I went over to the hosting guy and I said, hey, are we doing any, is it all for production, or are we doing like testing of new products and stuff like that? And he didn't give me a clean answer yet, so I'm waiting for him to come back to me and see what we do on those servers. Because when Patrick mentioned that, it kind of piqued my interest and said, oh, that's a good question to be asking the hosting guys.
Oh, that's great. Well, I'm glad there's still something that you can learn from the conversation. That's great. Well, and that leads into another area, and again, this just a specific area of professional services and implementation expense that, for both of you at companies that certainly are a little bit larger than early stage companies, where oftentimes the people and the headcount doing pre-sales are also doing post-sales. And then it becomes difficult for the finance organization, how do you split them up? 50-50? Do you put, is it activity-based? Is it headcount-based? I assume in your companies this is fairly well defined, the headcount and personnel and expenses around pre-sales for creating demos, hand-holding of prospects maybe during a trial, as compared to after you close a deal. But still, as you mentioned with R&D servers and hosting servers, sometimes even at larger companies it can bleed through. So have you seen any issues around that in terms of the services people that you, or another thing that we've seen, just to throw that out there, is where services is using systems to manage their billing, their time, and all of that, and that sits in G&A sometimes and doesn't always get allocated into cost of goods as it might. So any thoughts around that, Kerman? Since you were the last to speak about that, I'll pick on you.
No, the way that you have it here is how we do it. So pre-sales goes into sales costs and as part of our CAC, and then all the professional services stuff ends up in COGS related to the implementation and any other. And it is really related to the contract, right? So we have when we sign a statement of work or a contract with the customer, that's when the PS folks get involved and all their cost shows up in COGS.
Okay. And interesting, just before I let you go and move over to Patrick, somebody asked the question, do you split the cost of DevOps between COGS and R&D, or is DevOps 100% in COGS at your company, or how do you do it?
And when we say DevOps, that's the operations related to the hosting services?
Yeah, DevOps typically, and anybody can correct me because I'm not a tech person, but DevOps typically is everything around, you put things on test servers and then you move it into production. You've got QA around the test server, but most hosted SaaS applications, they may be doing an update every single day. They may do updates once a week. So it's a regular chain of updates to your application, which your customers are using, and you have people and resources that are moving it along and testing it and making sure that it works. And then, the associated security is a huge aspect of that.
Yeah, so we do put some of that stuff into COGS, and the way that it happens here is that we amortize our software costs. So part of that amortization ends up in cost of goods sold. Now, I'm not sure if I'm answering the question correctly, but because we don't call it DevOps, but we do have some of those costs flowing into cost of goods sold.
Okay. And Patrick, maybe you can start at the tail end and talk about DevOps, and then talk about if you have any issues between splitting out pre-sales and post-sales services.
Yeah, so our DevOps sits in COGS. It's still kind of a new and growing function at Everbridge. But for now, I think I could certainly see rationale for splitting their time, but I just hate splitting time. It's more manual work to add into the calculations that I'm just afraid, 6 months from now, 9 months from now, either the rationale for that split will have changed, or somehow we'll forget to do it. So I prefer to keep it clean and just keep them in COGS, because that's where the bulk of their effort is. And same goes for, I think you had asked earlier at the beginning of this question, Lauren, about when you're a smaller company and people wear a number of different hats, how do you map them on your income statement? So we just acquired a company that is in that stage. They have people who do pre-sales, and they also bill their time for professional services projects. And so what we've done with them is we've just tried to go individual by individual and say, where do they spend 51% of their time, and use that to guide whether they sit in our cost of revenue or in sales and marketing. And I guess we know that that's not perfect, but also stepping way back, whether it's DevOps or questions like that, we're just trying to be mindful of what's material. And if we put a lot of time into trying to split their effort and map their costs accordingly, did the answers change so much that management would make different decisions about our business model going forward? And if the answer is no, then I just don't do it. But it's always a great question to revisit. Have things changed where now doing that would be beneficial? Then we might do it going forward. But do try to keep it simple.
Cool. Well, I think that's a great lead into our last slide, which is just really a recap from both of you on what you find the best ways to, it sounds like you're always balancing, what I'm hearing from you, you're always balancing, keep it simple and focus on what's important, try not to get too complicated unless you think there's a material impact. But at the same time, as your company grows, it gets more and more complicated. So what are any thoughts on your best practices in terms of making sure that the metrics are calculated correctly, but also keeping it simple so that you can automate it and not have a lot of manual stuff to do on the side as you're trying to calculate it? So start with you, Patrick, since you just finished up, and we'll go to Kerman and take it from there.
Yeah, it's one thing I've taken away from earlier conversations with Kerman was what resonated with me was the idea of, when you're creating your cost centers, make sure that you're doing it in a way that aligns with how people control costs. So don't create cost centers where someone doesn't necessarily have direct authority over the costs hitting that cost center, because otherwise you're creating kind of a bucket that risks not being looked at with the scrutiny or the accountability and ownership that you might need as you're trying to scale your business. And that actually comes all the way back to the freemium costs that I was thinking about earlier. Right now they are in a bucket where I think the owner of that bucket doesn't necessarily, it's not his or her responsibility to drive the freemium model, right, and get the freemium folks on a clear path to becoming paying folks. And if we were to take that cost and assign it to someone who would have much more direct control and authority over that, then that would probably yield better results, longer term for the company in terms of efficiency and revenue generation. And so I think, keeping it simple, keeping it actionable, focusing on what matters, and when it comes to folks like us in our roles and building out the infrastructure to make that possible, keeping it aligned with control so that the insights that we generate from the data become actionable and they don't necessarily just become interesting metrics.
Yep. No, that's great. And Kerman, I'd love to have you follow up on that because you had some great experience on cost centers, because I've talked to some companies that really agonize over how do they set up their cost centers, thinking about how are they going to track CAC and unit economics and all that kind of thing. And you've been at companies with thousands of cost centers, and you're trying to keep it simple but useful. So what's your rule of thumb there?
Yeah, so at Adaptive, since we're much smaller than, let's say, a Symantec-sized company, at Adaptive, my general philosophy is that you don't want to create too many cost centers too far down in the organization with the expectation or with the idea that you're going to get a lot of control out of it, because, as Patrick mentioned, the further down you go, you end up getting this false sense of, okay, well, I've pushed it all the way down to the actual department owner, and he can manage it, he's going to be able to explain it. But it turns out that, in my experience, then you actually lose some of that control because there's really no one looking at it, because that department manager may not feel like he's empowered to make decisions. He's not a part of the approval chain. He's not part of any of the real discussions that go on around kind of the financial model or the results of the business. So I have a general philosophy that you at least start at one level below the CEO for cost centers, and then you take it one level below that, and then you're at the VP director level, and you say, okay, at that level, in a company like Adaptive size, you might have 30 cost centers, and I think that's really manageable. That puts it at a level that people can actually maintain and say, like, okay, you're responsible for that. It's big enough where they feel the responsibility and they're at the right level of approval process, and there's signature authority, and it doesn't have to go down too far. So I think all of those things make a lot of sense to me, especially as we're trying to do tracking of CAC, where it doesn't make sense to create a cost center for SMB West, SMB East, SMB Central, SMB Canada. Can we actually track cost that way? What about, and then as you consider, well, what if the Canadian guy covers Canada and the East, and then how do you split those costs, and does it make any sense to do that? So all those things come into consideration, because you do want some granularity so that you can do effective measurement, but then you also don't want to overburden your process and have to hire a bunch of people just to track headcount or do these splits or do allocations, so that nothing makes sense. So it is a kind of an art, blended with a philosophy around how much you can control and how much visibility you want. But my general philosophy is you go down 2 levels below the CEO in a small company, and then you kind of make an evaluation there. In a large organization like I was at Symantec and Veritas, we typically that's 3 levels below the CEO, 3 or 4, and then you're kind of at a good point. Just anecdotally within Symantec, I think we had like 2,500 cost centers, and we did a cleanup when we did a ERP conversion, we decided to do a cleanup of all these departments, and then we ended up, at something. I think we got it down to like 800 or something like that. I can't remember the exact number, but it improves a lot of things around processes when you reduce the number of cost centers. So my general philosophy is keep it simple and just don't overdo the number of cost centers you're creating to capture these costs.
Cool. Well, you both have been terrific. I really appreciate your input, and I think from the attendance and also the questions that we've gotten, this is a hot topic, and everyone's working with it because none of these things are exactly defined. So thank you both very much. We've run up against the top of the hour, and if anyone has any additional questions and they're on the line, please feel free to contact us directly or come to our website. There was a quick question about benchmarks. Obviously, we benchmark these things with software and SaaS companies, and we're happy to talk to anybody about that. But again, thank you, Patrick. Thank you, Kerman, and thank you to all the attendees for participating today. Thanks again. Take care, everybody.
Thank
Bye.
you. Thanks, Lauren. Bye. Thanks, everyone.